The USA is the largest oil-producing state in the world today by a wide margin. Beginning in 2008, its oil industry reversed a half-century slowdown, and then just a decade later, it exceeded the annual production rate of Russia and Saudi Arabia. The USA now produces so much oil every year that despite being the #1 consumer of the stuff domestically, it still has enough left over to be the world's largest fossil fuel exporter, and it really isn't even close. In 2024, the USA produced more oil than every single country in the Persian Gulf combined. What's more is that it sits right on the doorstep of the world's 4th largest oil exporter, Canada, and is by far their largest customer, piping almost 4 million barrels a day into American refineries from across the border. The United States of America today is simply the world's largest oil producer, refiner, user, and exporter, all rolled into one star-spangled package. So, to put it bluntly, why does America, or more specifically the American oil market, give a single left welly about what happens half a world away in the Strait of Hormuz? Even in a total global market system, only around 2% of the oil America consumes every day comes from this waterway, so it would seem the doomsday scenarios about this flow being cut off and America not even realizing it yet are overblown at best or downright misleading at worst. And that's not all. If we conveniently ignore the small little fact that it's going to be absolutely crippling to average consumers who are already struggling under cost of living pressures, higher oil prices could actually be a good thing for American oil production, which is dominated by onshore shale extraction in the Permian Basin, a process that has a higher base cost of production than oil from the Gulf, and therefore enjoys the higher margins that come with the higher prices. In fact, before the conflict in Iran started, the US Energy Information Administration had a very different concern to what we have today. Oil was getting too cheap. They had estimated that the majority of America's recent production gains had a break-even price of just over $60 a barrel for West Texas Intermediate, meaning that since barrels were selling for about $65, they had a less than 10% margin to fund future expansion and return a profit to their investors. That was a potential problem because production had become so efficient in America that the same organization was predicting that prices would slide to just $50 a barrel by 2027, making it financially non-viable to continue new oil development. Obviously, today, that is no longer a concern. So then, what exactly is the problem? In a situation like this, with such tangible costs, unknowable outcomes, and room for hyperbole, it's important to actually understand the boring mechanics of how this all works. And in this case, there are really 4 ways that supply restrictions in Hormuz could come back to hurt America, even if they do look completely sheltered from immediate supply problems. Depending on how long this goes on, it could be significantly more devastating to the American way of life than just paying European prices to fill up the car. As always, I respect your time and I don't want to waste it for the sake of view duration. Some of these factors may already be obvious to you, so timestamps are in the description if you want to jump around. Okay, so the first reason why all of this is still a problem for America is the way that oil actually flows through their market. Because without understanding the basics of this flow, it's almost impossible to understand how anything affects anything else. Ultimately, there are only 2 ways that crude oil gets to the US system at all. You either pull it out of the ground inside the country, or you bring it in over the border on a pipeline, a ship, or a train. Last year, domestic US production of crude oil came in at a record 13.586 million barrels a day, more than Saudi Arabia and Russia combined, and an all-time record for any single country at any point in history. The bulk of that comes from just one place, the Permian Basin, straddling West Texas and southeastern New Mexico, which alone is now pumping nearly 8 million barrels a day. On top of that, the federal offshore Gulf adds around 1.9 million barrels, the Bakken in North Dakota ships in a little over 1.1 million, and a long tail of smaller plays across Eagle Ford in South Texas, the Niobrara in Colorado, and a few odds and ends in California and Alaska makes up most of the rest. Oh, and on top of those 13.6 million barrels of actual crude, the US natural gas industry coughs up another roughly 6.8 million barrels per day of natural gas plant liquids, like ethane, propane, and butane, that get counted as petroleum products separate from the natural gas itself, which is primarily methane. These are also produced in crude oil refining, so they get lumped in together. In total, the entire fossil fuel input column of the American economy clocks in at over 20 million barrels of oil and oil equivalent every single day, which is a lot. But despite record-breaking levels of domestic production, the USA imported an extra 6.2 million barrels of crude oil on top of this every single day in 2025. Just over 3.9 million of those imported barrels came from Canada, which on its own makes up nearly 2/3 of every imported barrel landing in America. Most of it travels south on the Enbridge mainline and the Keystone system from the oil sands of Alberta, ending up at the refineries in the upper Midwest and the Gulf Coast. After Canada, the rest is genuinely scattered. Mexico sent around 383,000, Saudi Arabia 269, Brazil 198, Colombia 194, Iraq 179, Nigeria 137, and a long tail of smaller suppliers from Africa and Latin America make up most of what remains. Add up every single barrel that physically transits the Strait of Hormuz on its way to a US port, Saudi Arabia, Iraq, Kuwait, and the UAE, and you get around 490,000 barrels per day. In plain English, that is roughly 8% of US crude imports and just 2.5% of total US crude supply once you add in domestic production. So if the Gulf shipments, hypothetically, stopped tomorrow, in raw volume terms, the USA could, in theory, cover the gap with a single good week of Permian production growth. So that is the input side of the bucket, but where does it actually all go? Once it's in the system, all of this crude oil can really only do one of three things. It can be refined, it can be put into storage, or it can be shipped right back out as crude exports. Roughly 16.4 million barrels per day go directly into refineries, which, again, is the highest refining capacity of any country on Earth by a wide margin. The next closest is China, and they aren't running flat out the same way America's Gulf Coast refining belt is. The US has 132 operating refineries on the books today, but the picture is far more concentrated than that number suggests. The top 10 facilities alone account for nearly a third of the country's total processing capacity. Places like Motiva's Port Arthur facility, the single largest refinery in North America, at over 600,000 barrels a day, Marathon's Galveston Bay complex, ExxonMobil's Baytown campus, and Saudi Aramco's Motiva site all sit on the Gulf Coast and were built specifically for the type of crude that gets shipped in from international markets. These refineries are so large and efficient that for a lot of other countries, it just makes more financial sense to import their crude to be refined in the USA than it does to try and do it domestically. This is part of the reason why America, the world's largest oil producer, still imports even more oil. But it's also not the only reason. Now, the second place that oil imports and production can end up is in storage in a facility like this. This is the Cushing Tank Farm in Oklahoma, the facility where every barrel of West Texas Intermediate has to be physically delivered when a futures contract expires. When you're doom-scrolling oil prices, this is the place where that oil actually changes hands. Cushing is just acres and acres of giant cylindrical tanks held by midstream companies like ONEOK, Enbridge, Energy Transfer, and Plains. These companies make money by temporarily holding barrels until the speculative oil markets tell them to release them to whomever happened to hold the futures contract when it's settled. They're basically the capacitor on a giant electrical circuit, charging and discharging crude oil to keep the flow into refineries stable when production and demand don't quite line up, all moderated by finance bros looking at spreadsheets back in their air-conditioned offices. Fun fact, the storage system is also why in April of 2020, the price of WTI crude oil briefly went negative, because every contract holder who hadn't sold their position was contractually obligated to take physical delivery in Cushing, and Cushing was almost full. It was literally cheaper to pay someone to take the oil away than it was to pay one of these yards to store it. There are also similar, albeit smaller, storage facilities at every major port, every major pipeline junction, and underground in the 4 salt cavern complexes. Bryan Mound and Big Hill in Texas, plus West Hackberry and Bayou Choctaw in Louisiana that make up the Strategic Petroleum Reserve. Collectively, these storage facilities will all eventually feed back into the supply side, and that leaves a big gap for the most unintuitive place that this crude can end up once it's in America, and that is on a boat leaving it again. In total, the US exports around 4 million barrels of crude oil every day, and this raises the reasonable question, why would America import so much crude oil on top of its domestic supplies just to export it in its raw form all over again? Well, there are actually 3 reasons for this, and each one of them has its own slightly different exposure to a Hormuz shock, so they are all worth understanding individually. The first reason is just geography. The US is a really big country, and moving a barrel of oil from a wellhead in the northwest to a refinery on the Gulf is not always cheaper than just loading that same barrel onto a ship and sending it overseas. The classic example here is the back-end crude up in North Dakota. There are no major pipelines running directly from the back end to the Gulf Coast refining belt, so for most of the last 15 years, that oil has either been railed across the country to the East Coast, places like the PBF refinery in Delaware City, or shipped out of the Pacific Northwest to refineries in California, Asia, and even back into Canada, because for a lot of these barrels, overseas is genuinely closer than Texas. The same logic also works in reverse on the input side. Some American refineries, especially the smaller independent ones on the east and west coast, can buy crude off the international market for less than it would cost them to source it from a domestic field on the other side of the country. Hawaii is the most extreme example of this entire dynamic. The islands are incredibly remote, and thanks in part to the Jones Act, shipping commodities from the mainland is not financially viable, so they have historically just imported their crude, and increasingly their fully refined gasoline, diesel, and jet fuel directly from places like Libya, Argentina, and the Asia-Pacific market, basically skipping the American oil system entirely. Now, with all that in mind, it's extremely rare that a barrel of crude is imported from overseas just to be exported again, apart from maybe a small amount that gets parked in speculative storage at Cushing while traders play in international markets. The vast majority of these imports and exports are 2 separate flows passing through each other in opposite directions. The second reason for the import-export dance is more of a misunderstanding about how the refining business actually makes its money. The USA is technically a net crude importer, but that's largely because its refining capacity is so massive that it imports crude on top of its own production, runs the combined volume through the densest refining network on Earth, and then sells the finished gasoline, diesel, jet fuel, and other petroleum products back to the international market at a markup. The fact that the USA is also the financial center where most of these oil contracts are settled in the first place just makes the whole arrangement even more lucrative. The refining margin and the financial settlement fees are essentially being collected on the same barrel twice over. And the third reason for the simultaneous imports and exports is a little bit more technical, so we'll get to that in a bit because it ends up being one of the most important parts of this whole story. Now, one final thing to flag before we move on. The numbers we've just gone through don't quite add up perfectly when you compare inputs to outputs, and that's because some volume is lost in the refining process. There's always a certain amount of unaccounted for spillage, and at this scale, even just the pipes physically connecting all these markets together hold millions of barrels of oil inside them. The USA at any given time has more oil sitting inside its pipelines than a lot of countries have in their entire economy. Now, some outlets have started running the line that the last ships leaving the Persian Gulf and bound for America are arriving in port right now, and once those barrels are used up, it's game over. And that framing, to put it generously, is a little bit disingenuous. The actual problem is not whether the last tanker out of Ras Tanura makes it to Houston. The actual problem is what happens the moment it becomes more profitable for an American oil company to export their product to a more desperate buyer in Tokyo or Rotterdam or Mumbai than it is to sell it to the local Houston market. Even though the USA as a whole produces enough oil to support its own domestic demand without strictly needing any other country, the US oil market is not a single monolithic bucket. It is dozens of smaller, semi-independent buckets, all passing barrels around between each other, often in genuinely unintuitive ways, and a lot of these individual buckets are deeply dependent on the international market. If that international market gets choked off, even briefly, it puts an enormous amount of pressure on the entire system in the short term, even if the long-term aggregate numbers say everything should technically be fine. Understanding this is the foundation to understanding the other simple, practical economic reasons why a rounding error worth of lost import volume could undermine the very foundation of our modern global economy. Now, once you actually look at this whole flowchart laid out, the obvious question becomes, if the USA has its own production plus a friendly neighbor piping in another 4 million barrels a day, plus enough refineries to process more crude than any other country on Earth, why does it import anything from the Middle East in the first place? And the answer is the second reason that an oil shock half a world away can absolutely batter the American oil market, even if it never directly takes a single barrel away from a US refinery. And that is, unlike a lot of oil states with nationalized resources, this American oil isn't really America's oil. Despite politicians of every flavor talking about our oil and American energy independence, almost every single one of the barrels we just talked about, with the only exception of the strategic reserves, belongs to a private company. The Permian Basin is private land leased out to companies like ExxonMobil, Chevron, ConocoPhillips, Pioneer, Diamondback, and EOG. The back end is mostly the same story. The offshore Gulf is technically federal water, but that water gets leased to oil majors who then own the barrels they pull out of it. The refineries are owned by the same handful of majors, plus dedicated refiners like Marathon, Valero, and Phillips 66, and the storage tanks belong to the midstream companies we already mentioned. Even the Strategic Petroleum Reserve, which is owned by the federal government, only contains a few 100 million barrels, which is about 30 days worth of total US consumption. In plain English, these barrels are not flowing around the system to achieve strategic objectives, they are flowing to where they can make the most money. ExxonMobil, Chevron, and the rest of them have a legal fiduciary duty to their shareholders to maximize returns, and a CEO that voluntarily sold barrels into a domestic market for $80 when international buyers were offering $120 would very quickly become a former CEO. Right now, the USA gets relatively cheap petroleum products, gasoline, diesel, jet fuel, and petrochemical feedstocks, because so much of it is produced and refined within the country, and shipping a barrel from Houston to Houston is always going to be cheaper than shipping it from Houston to Rotterdam. But the moment a buyer in Rotterdam or Tokyo or Singapore gets desperate enough to outbid the local Houston buyer, those barrels start moving in a different direction, and those buyers get desperate the second their normal supply from the Gulf gets choked off. The numbers here are not small. Last year, the USA exported around 6.7 million barrels a day of refined products, gasoline, diesel, and jet fuel mostly, on top of its 4 million barrels of crude export. Mexico, China, Japan, and yet again Canada are the biggest buyers of those refined products, and almost every single one of those countries also buys oil out of the Persian Gulf. In particular, Mexico, which despite producing its own crude has let its domestic refining capacity wither over the last few decades, now imports something like 60% of all the gasoline it consumes from American refineries just across the border. So if their Gulf supply gets cut off, they aren't just going to politely accept that they now have less fuel. They're going to come to the next biggest open market and start bidding up the price of US gasoline, diesel, and other products until somebody loads it onto a tanker heading their way. The American oil companies, the American refiners, and the American midstream operators are then either going to ship their products overseas, or they're going to expect the domestic market to cough up a competitive offer. Either way, the price at the pump in Phoenix and the price of jet fuel at LAX and the price of diesel in every long-haul truck stop in Pennsylvania is going up, regardless of whether a single barrel of the actual physical oil came from anywhere near Iran. In a prolonged crisis, the USA could theoretically nationalize its oil, but this would be such a radical step that it would undermine faith in the US business environment for decades to come, so it would really just be trading one problem for another. Being a net producer doesn't insulate the country from a global price shock when your producers have full legal authority to sell to or buy from anyone in the world outside of a few sanctioned states. And this brings us neatly to reason number 3, which is that even though the USA produces enough oil to theoretically cover its own consumption, the oil it produces is the wrong kind of oil. Crude oil is not a single product, it's a category of products, and refineries are extremely picky about exactly what they want to feed into their distillation columns. The two big variables are weight, technically measured in something called API gravity, which sounds complicated but is basically just how thick or thin the oil is, and sweetness, a really misleading way of defining how much sulfur it contains. Please don't drink the oil. American shale crude, the stuff coming out of the Permian and the Bakken, has an API gravity of around 40 to 45 degrees and almost no sulfur, which makes it what's known as light sweet crude. This thin, low-sulfur crude oil is extremely easy to process and is frankly kind of a luxury product for refiners. By comparison, Saudi Arabian Arab Heavy comes in at around 28 degrees API with sulfur content above 2%. And Canadian oil sands bitumen is so thick it sometimes has to be diluted with lighter petroleum products just to flow through a pipeline at all. So not only does the USA produce a lot of oil, the oil it does produce is superior to almost everything else on the planet. So then, what's the problem? Well, the problem is that almost every major American refinery was built before the shale revolution kicked off in 2008. Back then, the US was on a long, downward production slide, and most of the imported crude was the heavy, sour kind from Mexico, Venezuela, Saudi Arabia, and the Canadian oil sands. So those refineries were specifically engineered at huge upfront cost to handle thick, sulfurous, gunky crude. Their conkers, hydrotreaters, and distillation towers are all sized and built for the heavy stuff. In plain English, American refineries are essentially heavy, sour-eating machines being asked to live on a country that produces light sweet salad. Now, refineries do best with a carefully blended mix of light and heavy, sweet and sour, kind of like mixing a good martini with the right ratio of dry and sweet vermouth. The blend a refinery is built around is called its feedstock mix, and there's an optimal ratio for every single facility based on what units it has installed. So American refiners use as much of the local light sweet stuff as they can get away with, and then they import heavy sour crude from Canada, the Persian Gulf, Mexico, and a few other places to get their feedstock blend back into that optimal range. After that, they sell off the leftover light sweet crude as a raw export. This is why the USA simultaneously imports around 6.2 million barrels of crude and exports 4 million barrels of crude every single day. It's not the same oil going back and forth, it's two completely different products being swapped through the same global market. The number one customer for the light sweet crude exports is the Netherlands, which buys American oil for its enormous refining hub in Rotterdam, where it gets blended with heavy sour from the Middle East and the North Sea before being sold out across Europe. South Korea does basically the same thing, and India does basically the same thing. But here is the important detail. Of the heavy sour barrels that American refineries actually need to get their feedstock just right, a non-trivial chunk comes through the Strait of Hormuz, particularly from Saudi Arabia and Iraq. Saudi Aramco, Saudi Arabia's state oil company, even partially owns one of the largest US refineries, the Motiva facility in Port Arthur, Texas, which was specifically configured to run on a steady diet of Saudi heavy crude shipped directly from the Ras Tanura on the Persian Gulf coast. To use a very American analogy, these facilities want peanut butter and jam sandwiches. Either ingredient by itself is fine, but not exactly satisfying, so if there's a global shortage of jam, having a literally endless supply of peanut butter doesn't really fix the problem. The USA could certainly retool its refineries to run on a higher proportion of light sweet shale, and some have done exactly that. But doing it across the entire refining belt would take years of capital investment and tens of billions of dollars, time and money that nobody's going to commit in the middle of an active geopolitical crisis. So yeah, it turns out that the global oil supply chain is kind of complicated, delicate, and technical. Carefully optimized systems generally don't deal well with disruptions, and even though America could theoretically close itself off, the systems just haven't been built like that. And since nobody knows how long this geopolitical stalemate will last, none of these companies wants to be the first to commit to a multi-billion-dollar, multi-decade retooling effort. It sounds bad, but everything so far is a minor technicality compared to what this supply disruption could do if it's allowed to go on for long enough. So yeah, the fourth reason has almost nothing to do with the physical oil itself, and almost everything to do with what the world has agreed to do with the US dollar for the last 50 years. In 1974, shortly after the first global oil crisis, and well after US domestic production had already begun its long decline, Henry Kissinger flew to Riyadh and signed a now famously secretive arrangement with the Saudi royal family. The Saudis would sell their oil exclusively in US dollars, and in exchange, the United States would guarantee their security against any regional rival, and probably their own people if it ever came to that. Since the Saudis were generating more cash from oil exports than they could realistically spend, they parked the surplus in US Treasury bonds, which gave the American government a reliable, deep-pocketed, politically friendly international lender to fund its growing deficits. This entire arrangement, selling oil for dollars and recycling the dollars into US Treasuries, is what eventually became known as the Petrodollar loop. And it gradually expanded out from Saudi Arabia to include almost every other major oil exporter on Earth. This also meant that pretty much every other country on Earth needed to hold US dollars too, because oil could only be bought in dollars. The dollar hadn't actually been backed by anything since Nixon closed the gold window in 1971, but who cares about gold when the entire global economy has agreed to back its currency reserves with the implicit promise of a barrel of Saudi crude? This single arrangement is arguably the most important reason the US dollar stayed so dominant as the world's reserve currency. One of the reasons why American interest rates are lower than they should be for a country with its level of debt, and the reason why the New York Stock Exchange and the US Treasury market are the center of global finance. It's also the reason why the United States can run budget deficits that would normally crater a smaller economy, because there's always an international buyer somewhere willing to swap their hard-earned export dollars for a US Treasury bond. And it's also the reason that when the missiles started flying in late February, some very nervous people in the US Treasury Department started watching the bond market a lot more closely than usual. Since the strike on Iran on February 28th, foreign central banks have been net sellers of US Treasuries for 5 consecutive weeks. Custody holdings of treasuries at the Federal Reserve Bank of New York have dropped by roughly $82 billion to $2.7 trillion, the lowest level since 2012. The 10-year Treasury yield, which in every other recent crisis has fallen as money rushes into safe haven assets, instead climbed from 3.9% at the end of February to above 4.4% within a couple of weeks. Now, the mechanism for this is actually pretty simple. These Gulf oil giants aren't selling much oil right now, which means they aren't earning the dollars they would normally be using to buy back treasuries. At the same time, they're selling their existing treasuries to keep their domestic economies afloat without the income they normally get from oil exports, which is roughly the equivalent of an unemployed person dipping into their savings account to cover the rent. The combined effect is that demand for US government debt is dropping just as supply of it is growing, which is making it harder for the US Treasury itself to borrow money, and pushing US interest rates higher across the entire economy, from credit cards to mortgages to corporate debt. In real terms, that means the Hormuz crisis is already showing up on the loan application of every American trying to refinance a house, every small business trying to take out a working capital line, and every college student trying to lock in their student debt. None of which has anything to do with the price of a barrel of oil in Houston, and everything to do with what oil exporters are choosing to do with their dollars in New York. Now, this would be bad enough by itself, but to make matters significantly worse, Iran is now reportedly allowing tankers to pass through the strait if the buyer is willing to pay in Chinese RMB instead of US dollars. As the great Hopper once said, for America, this is not really about oil, it's about keeping those ants in line. China has spent the better part of a decade trying to convince the world's oil exporters to settle in something other than dollars, and they've had limited success because there's never really been a compelling moment to switch. For now, the overwhelming majority of global oil trade is still settled in US dollars, but the longer this goes on, the more buyers are going to look for alternatives, and every alternative that gets battle-tested today is one less reason to trust the dollar tomorrow. If the petrodollar system genuinely starts to unwind while the US is sitting on its current pile of debt, it is hard to politely express how truly bad that could get. And that's coming from a Brit who knows a thing or two about global trading systems breaking down around them. This has been the de facto financial operating system of the Western world ever since Bretton Woods. The petrodollar unofficially replaced the gold standard, and if it falls apart, lining up at a gas station for rationed fuel is going to look like a pleasant afternoon picnic compared to what comes next. So that's why the largest oil producer in history still cares a lot about the 21-mile wide stretch of water on the other side of the world. The USA is genuinely blessed with enormous domestic production, so it isn't going to feel the immediate physical impacts of the Hormuz disruption nearly as quickly as Europe, Japan, South Korea, China, or India will. Some American oil producers are even going to make a lot of money on the price spike. The Permian shale guys with their high break-even costs are about to enjoy a year of margins they could only dream of 6 months ago. But in the long term, the country has just as much, and arguably more, to lose than anybody else because it isn't just exposed to the price of oil. it's exposed to the entire global financial architecture that's been artificially propping it up for over half a century. It is a net producer of barrels, but it's even more a net producer of dollars, and dollars are the one product the world might actually start to question if this drags on long enough. Now, if all of that was a bit too doom and gloom, don't worry, because there's one group that's absolutely loving this, and that's the grey market oil tankers roaming the world's oceans. Go and watch this video next to find out why bad news for the world is great news for their bottom line.